So what are some of the key considerations to retiring early? Plus, we've got some troubling statistics for the investing behavior of sort of the opposite ends of the age spectrum, the Gen Zers and the baby boomers. So we'll cover all of that here on the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region. If you miss us on our live show here on Sunday morning, well, there's always an opportunity to catch us during the week on any of our podcast channels, along with our YouTube video. Just look up Nelson Financial Planning on any of those platforms and you'll get connected to our channels. My name, of course, is Joel Garris. I am a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and financial plan. Well, my goodness, first and foremost, speaking of that team, thank you very much to fellow certified financial fiduciaries Rob Field, Kristen Cayley, for hosting the program last week in my absence. We want to certainly give them a shout out and appreciation for a good program. Had the opportunity to listen to it. Hopefully you did as well. And as always, an informative format that we follow here on Dollars and Cents. Of course, this first segment of the program, we often talk about the most recent headlines, if you will. Hard to believe that at the end of today, July will be in the books. Tomorrow, the start of August, after certainly a rough second quarter for the markets. The month of July actually got things off to a good start for the third quarter. Overall markets for the month of July, best month since 2020. S&P 500 up about 9%, a little over 9%. NASDAQ, if you like to track more of those growthy techie, actually up over 12%. So decent start to the year. And if you stop and think about sort of what was going on, some interesting headlines that sort of juxtaposition with that market performance, right? So for the week, we talked about those stats for the month of July. A lot of that improvement for the month of July actually happened this past week when the S&P 500 was up over 4%, about 4.3%. On Friday, for example, it is earnings season, which is why you see as much sort of movement in the market here in the midst of summer than what you might otherwise expect. But this time period is obviously earnings season for the second quarter. And so companies like Amazon and Apple on Friday, for example, had better sales numbers than expected. And obviously that led to some decent improvement in terms of the market. The juxtaposition, of course, was the other headlines besides the corporate earnings results that were coming out in spades this past week. You had the GDP data, the negative number for economic growth for the second quarter. We obviously will be having a discussion of recessions and all of that here on this program, because if you're a regular listener to the program, you know that you should be relatively familiar with this concept of a recession, because we've been talking about it for many weeks and probably even months now, because our view has been for several weeks now that we probably already are in the middle of a recession. Remember, recessions are a normal part of the economic cycle. So not something you get scared out of your wits on, but just something that we all have to appreciate and understand. Hey, it's part of the economic cycle. And so our view for several weeks now is that we probably already were in the middle of one. It's kind of hard to avoid that, right? When inflation is as high as it is, when the Federal Reserve is raising rates at the most aggressive pace that we've ever seen in probably over 40 years, that's not a particularly great combination to promote economic expansion. And so now, consequently, the data came in this past week on Thursday that says, well, we've got one, or do we have one? And here's where the story got kind of interesting over the past few days, because the media is tripping all over itself not to describe it as a recession. And there's some truth to that approach, because some of this stuff can be sort of self-fulfilling, right? If somebody keeps telling you things aren't good out there, then you start to behave more and more like things aren't good, maybe pull back on spending, things like that. So that's why there's this hesitancy to sort of embrace this term recession, because some part of it can be self-fulfilling in terms of the psychology all around it. And so it's one of those things where here's why it is a recession and here's why it isn't technically yet, right? So let's start with the economic definition of what a recession is, and that is you have 2 consecutive quarters of negative GDP growth, right? So first quarter, that data came out a while ago. In fact, at the end of the first quarter, it was projected that the first quarter of for the economy, it was a shrinkage of 1.4%. Those numbers come out after the end of the quarter, so we're talking about data from April, and then they revise it. And it's the revisions part that kind of make this whole conversation of are we in a recession or are we not kind of a little wonky, because, very technical term there, by the way, wonky. Anyway, because the data gets revised, in fact, 3 different times, then it's hard to really kind of peg the numbers. For example, first quarter GDP data was revised for the 3rd and final time as of Wednesday, actually showing that first quarter of this year contracted more than what was originally reported, a contraction of 1.6%. Data that came out on Thursday was the initial take or initial read, if you will, in the second quarter, a decline of minus 0.9%. So, right, 2 negative numbers, 2 quarters in a row. That would sort of hit the definition, the textbook definition, if you will, of a recession. But the official arbiter of whether something is or is not called a recession is, in fact, a government organization called the National Bureau of Economic Research. And they are the ones that define whether there's a recession or not. So, and because obviously there's multiple revisions to the data, it can change, so nothing is, sort of permanently set. And the reality is the length can also be different, right? Because if we think back to March of 2020, it was basically the COVID shutdown, February, March, April. That's only 3 months, but that has been defined and classified as a recession. So there's 3 factors that go into the call of that the National Bureau of Economic Research makes that determines whether it is in fact a recession. It has to deal with the depth, meaning how dramatic was the economic pullback. And obviously, if you think back to the COVID decline, well, that was a pretty steep decline when you're shutting down the economy. It has to go with the diffusion, how much of the different areas of the economy are affected. And then lastly, the duration. So the duration part is only one piece of those 3 pieces in terms of sort of where the economic numbers are. We're going to take a break. We come back. We're going to kind of continue this conversation about the economy, recessions, and things like that. Obviously, very pertinent to last week's headlines here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit about recessions and the conversation that obviously was front and center of many headlines this past week involving recession data, what it all means, and are we in one, are we not? I think at the end of the day, we've been talking about it for several weeks. Recessions are part of the normal economic cycle. Today on the program, we're giving you a little bit of a background of sort of the debate that is occurring because the official call to the beginning and end of a recession, whether something is a recession or is not, is actually determined by the National Bureau of Economic Research. Certainly, based upon the economic data, negative 1.4% or negative 1.6% growth for the first quarter of this year, along with Thursday data, negative 0.9% contraction for the economy for the second quarter. All right, you've checked the box in terms of one part of a technical definition of a recession, but when you think about the data and what goes into a recession, it is in fact three different factors. It's duration, and obviously that comes into play in terms of how long it is, but it's also diffusion and its depth, right? How deep is the economic impact? How broad is that economic impact? And that's why when you think about when there sort of is a definition or a clarity, if you will, of that word, if you look at some of the prior recessions, I mean, six different recessions since 1980, the official start of those recessions was typically announced 6 to 9 months after they actually began. So you can see where there's a pretty significant log in terms of the call, if you will. There's also an even longer period of time for the call to a particular end of a recession. Again, looking at those 6 recessions since 1980, right? So that's 6 and 40 years, right? That's something that happens on a somewhat regular basis. The end was typically announced, if you look at sort of the National Bureau of Economic Research and sort of the calls that they make, the end was typically announced anywhere from 12 to 16 months after the actual end of a recession. So that's why you're kind of hearing this conversation of, are we in a recession or are we not? The reality is that when you think about 2 quarters in a row of negative growth, and you think about high inflation, we think about a Federal Reserve that is raising rates at a historic clip, it certainly feels like one, doesn't it? So, but there's the hesitancy and there's the conversation. Got a little bit more data to also share with you on this, but welcome back to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of that team, thanks to Rob Field and Kristen Cayley for hosting the program last week in my absence. We are back live here in the flesh, coming to you from the all-new Nelson Financial Planning Studios here at our office. The team has spent a lot of time putting this together. Also, could not have done that without the support of Super Dave over there at Clear Channel, and the team really has done a great job at outfitting it with the padding and the microphones and all of this stuff. So hopefully you notice a little bit better sound quality than what we would typically be. Certainly the dogs aren't going to be barking in the back like sometimes they were and have been over the course of the past couple of years when we were doing the show live from the house. So, but anyway, talking about the economic data and some of the headlines that came out this past week. Certainly, when you think about the impact, right? So you've got the economic data which shows that growth certainly slowed in terms of personal income. But it increased in terms of industrial production. Certainly the labor market's still quite strong. Interesting comment by Powell, Federal Reserve Chairman Colin Powell. Powell on Wednesday, talking about the economic data. He's saying, take the first cut of the GDP data with a grain of salt. I don't think that's an accurate statement. Certainly when you think about kind of the economic data that comes out, yes, in fact, the data does get sort of revised 3 different times for the economic data for a quarter, but certainly the first reading, that's your starting point. So you really shouldn't necessarily ignore that by any stretch at all. So anyway, we've probably spent way too much time talking about the economic theory behind whether something is a recession or not here on the program. Bottom line, it is a combination of three different factors: depth, diffusion, and duration, that determines whether something is purely a recession. That call, the official arbiter, the National Bureau of Economic Research, typically calling the start of a recession 6 to 9 months after it actually starts, and then calling the end of a recession 12 to 16 months after it already has ended. So the point is, don't get too hung up in the official call, beginning, middle, end. The reality is that if it feels like a duck, if it walks like a duck, if it quacks like a duck, it probably is a duck. And certainly that is hard to argue when you think about the reality that sort of is this COVID part 2 recession, right? One of the reasons why it was only a 2-month recession, the shortest recession in history, back in February, March, and April of 2020, was when you throw $7 trillion plus at it, and the number's much, much higher worldwide. Well, then, yeah, you can, in fact, fill a pretty big hole. The problem is that you create other factors, which is what we're dealing with certainly now. And that's the battle we've been talking about on this program now for several weeks and months, this battle between inflation and interest rates. Obviously, the other story this past week was the continued increase in interest rates, a second in a row, 0.75% increase. The sentiment this week, which explains sort of why the market behaved as positively as it did, sort of shifted with the thought that, okay, well, wait a minute, maybe with these dramatically quick and large interest rate increases, and with some of the inflation data maybe starting to wane, right? Full gas under $4, that's pretty good. The reality is that perhaps they won't have to raise rates as aggressively as was originally thought, and so the market sort of responded positively to that. But the suggestion, that future that Powell made, Jerome Powell, the chairman of the Federal Reserve, made this past week, was that perhaps those interest rate increases won't be as dramatic going forward. That certainly helped with the improvement in sentiment in the markets this past week and this past month. Of course, inflation data, once again, that official arbitrator of the Bureau of Economics personal consumption expenditure number came out at like 6.8%. That's a pretty high level of inflation. To get some perspective on it, I want to share with you this little tidbit of information, if you will, in terms of how much this inflation story, I think, is new to people, and how there's a generation of people that haven't necessarily seen what inflation looks and feels like. Here's the statistic that I saw, and this comes courtesy of the Department of Labor. If you were born on 12/31/1941, by the time you turned 40 years of age on December 31, 1981, you had lived through 9 calendar years, so about 25% of your life, with at least 7% inflation. If, on the other hand, you were born on December 31, 1981, by the time you turned 40 years old, 12/31 of 2021, you had lived through just 1 calendar year of at least 7% inflation. Stop and think about that for just a second. That time frame of that 40 years, if you will, 9 years at 7% plus, 1 year at 7% plus. So very different perspective in terms of this new concept, if you will, that many people are seeing for the very first time. Certainly way, way, way too early to call all clear, if you will, on this debate versus inflation versus interest rates versus recession. So bottom line, stay tuned to the program, and we will have much, much more on that in the weeks and months ahead. We're going to take a break. This is Dollars and Cents, Joel Garris of Nelson Financial Planning. Let me just give you that stat that we were talking about at the end of the prior segment, of just that comparison of inflation and who's seen it and who hasn't, and why it's a big deal when you have inflation in the economic system, and many people just haven't seen it. Here's the stat, right? If you were born on December 31, 1941, by the time you turned 40 years of age, so that would have been on 12/31/1981, you would have lived through 9 calendar years where inflation was in excess of 7%, or about 25% of the time. Fast forward, someone born on December 31, 1981, you would have spent the first 40 years of your life never seeing that until last year. So you would have 1 year out of the 40 where inflation was running at 7%. That's a lot of what the conversation is that's happening out there economically, and certainly that stat underscores what we are talking about here on the program for many months now, this battle between inflation and interest rates. Too early to call who's going to win that one. Certainly the market for this past week, this past month, is erring more a little bit on the side of maybe we don't have to raise interest rates as much. Maybe some of this inflation data is coming down a little bit, as we heard just in the news during the break, right? Average price of gas under $4 a gallon here in Central Florida. Bottom line, way too early to call anything at this point. Remember the investing fundamentals during times like this. Stay consistent, stay diversified. Sadly, we've got some stats that we'll share with you in this segment of the program that a lot of folks aren't exactly doing that at both ends of the age spectrum. So welcome back to the program. This, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. So if you are missing the live show here on Sunday morning, feel free to check us out during the course of the week, either on your favorite podcast channel or on our channel on YouTube at Nelson Financial Planning. Have any problem finding any of those stations on your favorite platforms? Just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, click on the icon that looks most familiar, and lo and behold, you will, in fact, be directed directly to our channel on that particular platform. My name, of course, it's Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So, what are the stats? What are the two disturbing trends, if you will, at both ends of the spectrum that we are seeing in terms of folks not staying consistent? Well, we've got some disturbing numbers to share with you on the annuity side that is directly impacting baby boomers, along with some statistics involving Generation Z, the most financially active generation ever, but perhaps too active when you hear some of these numbers. So let's go first to the annuity sales number. And as you know, if you've listened to this program at any point over the course of the 30 plus years that it's been on air, you know that we are not a fan of annuities, period. And we really haven't changed our stripes on that over the course of the past 30 years because the product is still the product. It's still a very expensive product. It typically locks down your money. And the reality is, once you realize how it all works, then you think to yourself, well, wait a minute, why am I going to sign up for that deal when I can understand what actually is happening? But all it takes is a little bit of a market decline, and the insurance salespeople certainly like that, because then that allows them to make as much hay as possible selling you a guaranteed, quote unquote, type of product. Well, guess what? The stats are in for the second quarter of this year. Sales of annuities hit a record $74 billion. That's $5 billion more than the previous record. Want to take a guess when the previous record for annuity sales was set? Fourth quarter of 2008. Last time there was a significant market decline. Oh, wait a minute, fourth quarter 2008. Well, if I had invested in the fourth quarter of 2008 rather than take all of my money and dump it in an annuity, I would have had a pretty good investment rate of return because I literally would have been buying at the low point in the market. Once again, we see massive annuity sales when the market goes down, breaking the record of annuity sales that was set in the fourth quarter of 2008. What's even more interesting about these, the data on this sales of annuities is that particularly on the fixed rate side of things, that's where the greatest amount of sales have been, which doesn't make sense once you understand a couple of things. First of all, understand how the product works, right? We're talking about a fixed annuity. Basically, that means that the insurance company isn't taking your premiums, investing them, and has every intention to make a higher rate of return than what they are guaranteeing to pay you out. That's how it works. On a fixed annuity, those assets become part of the insurance company's money to play with, to invest, much like you could do if you weren't getting suckered into an annuity. The reality is that that's how that works. Now, do you think the insurance company is not going to be able to do that? Because if the insurance company isn't able to do that, well, then you're not accepting the fact that the product is quote unquote guaranteed. Who is it guaranteed by? Not guaranteed by the FDIC. It's guaranteed by the insurance company that issued out that contract. So be careful when you hear the word guarantee. It's not some FDIC guarantee. It's a guarantee by the insurance company. How is the insurance company making that guarantee work? Taking your premiums that it's investing it, and it's making sure that it generates a higher return over time than what it is that it is guaranteeing you. Now, how do they do that? How are they able to kind of do that? Well, that's where the other part of these products comes into play. Typically, it locks down your money for typically a 3-year, 5-year, 7-year period of time, whereby if you want to get access to that money, you want to take your money out, there's a big surrender charges. In some cases, those surrender charges can be up to 7%, 8%. So big hits if you want to use your money. That's how it works. That's how they're able to do that, is by ensuring that they've got usage of your money that they can invest, that they can get profit on. Then they can guarantee you something that is going to be below that threshold, and that's how those products work. They are not a good product to own, particularly when you think about the surrender charges and things like that. They're also not a guaranteed by the FDIC insured product. They are guaranteed by the insurance company that issued it out. So that is subject to the whims and the implications of the insurance company itself. The reality is this as well. Set aside the fact that how it works is they're going to take your money, invest it, and make a higher profit and then pay you less. I don't understand why I would do that from an investment perspective. But if you also think of it, I think it's pretty clear that interest rates are going to go up. As interest rates go up, you make more money on things like savings accounts, CDs, things like that are FDIC guaranteed insured investments. Okay, well then, why am I going to jump into an annuity at a point in time where interest rates are on the run up, right? Wouldn't I be better off to kind of wait and see how those interest rates go up and then go into something like a CD, to the extent that I wanted to have something that was fixed, that was guaranteed, that was not going to fluctuate? Why would I want the guarantee of the FDIC rather than the guarantee of an insurance company? Why would I want that, particularly in an increasing interest rate environment? Why would I want to lock my money down for a 3, 4, 5-year period of time when pretty sure a year from now interest rates are going to be much higher? Correspondingly, the interest rate that you're making on CDs and things like that also going to be much higher. So why would I do that? Well, you should at the end of the day, but the bottom line is that insurance salespeople like to take advantage of whenever the market goes down to tell you that your money isn't safe and that you should be owning insurance products because they are in fact the only safe thing out there. Once again, listen to those numbers. Annuity sales highest level since fourth quarter of 2008. That's always the case. Annuity sales hit their highest at the point in time where you should not be putting your money into them. but history repeats itself. Certainly seems like that based upon the stats for annuity sales. We're going to take a break and return here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Talking a little bit about on the program some of the latest statistics on sort of both end of the age spectrums that suggest that sadly people are not staying consistent in terms of their investment approach and investment allocation. We always believe that that is probably one of the most important fundamentals when it comes to being an investor over time. The constant hopping in, hopping out, looking for flavor of the day, flavor of the week, if you will, stuff to invest in, ultimately undermines your long-term investment results. Certainly, there's a slew of research that's been done on this topic that underscores and highlights that fact. But each and every time there is a tough time in the market, well, then there's some disturbing statistics that always pop up. We spent last segment talking to you about sort of the statistics that sort of geared more towards what baby boomers are doing right now, and that is that you've got the highest amount of sales volume for annuities in the second quarter of this year, topping the record that was set in the fourth quarter of 2008. What's the similarity? Well, that's after the fact, right? That's when the market had gone down, and ultimately people were lured by the promise of guarantee, safety. The reality is that when you think about particularly how a fixed annuity works, that's the insurance company taking your money and fully expecting to make a better rate of return than what they're going to promise to you. That doesn't sound like a particularly good deal, right? At least in my mind. Why would I give somebody my money knowing that the whole ability to get whatever the return is that they promised me is predicated on the fact that they're going to take my money and do better than the rate of return that I have been promised? Why would I do that? That doesn't make sense. Well, the way they're able to do that, by the way, there's the fine print, if you will, on annuities, is it typically requires your money to be locked up for several years. And if you want to get access to your money, well, then that's where you then face a substantial penalty for early withdrawal. Plus, when we think about an environment of rising interest rates, if I really wanted something guaranteed, the FDIC guarantee is a better guarantee than any guarantee that an insurance company is offering. So why wouldn't I just kind of wait it out a little bit? Because interest rates clearly going much higher than where they are. But sadly, that is statistic number one, if you will, in terms of what's happening out there in the world at large. Statistic number two has to deal with the other end of the age spectrum, Generation Z. So we'll share that with you here in just a moment. This, of course, is Dollars and Cents, where we help you make sense of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries, much like Rob Field and Kristen Cayley, who hosted the show last week, stand ready this week to help you change your life with a successful and cost-effective financial plan that's designed to produce superior investment results and provide you with peace of mind for the future. So what's the stats sort of on the other end of the spectrum, if you will, in terms of investor behavior these days? Well, the young generation, Gen Z, if you will, which would be adults age 18 to 24, is an interesting generation in that it is a generation, I have 3 kids in that generation, and it's a generation that was brought up with technology being ubiquitous throughout all aspects of life. So I'm thinking about that. That generation really is the generation that grew up with a laptop in their classrooms. I remember when my kids were in elementary school and it was being rolled out as a Chromebook, and it was basically, a connection to the internet, and that was all the big new thing. And so consequently, they grew up with that. They went to school with that. It's always been in their hands. And there's some positive and negatives to that, so we're not going to get into that grand debate here on this program. But one of the interesting things is that because of that, that age group has actually been one of the most financially active age groups ever. And so when you think about kind of that access to information, that access that's always at your fingertips, the apps that you can do, things like Robinhood and things like that, that age group has actually been one of the most active financially. A total of 26% of the folks in that age group have at some point bought a stock. More active certainly than any other age group or generation at that particular age. Obviously a very social media generation, many of which learned about investing on YouTube or maybe even TikTok, which is a little troubling because, as you may know, if you are on TikTok, those are very short videos, and investing really does require a lot of nuances, right? Early in the program, we were talking about just the simple definition of recession. What is it? What does it mean? How does it work? And the reality is that even something as simple as that traditionally doesn't get officially described. The start of a recession doesn't get officially described till about 6 or 9 months after it has happened. The end of a recession doesn't get officially in the books until it's like 12 to 16 months after. So even with something as simple as straightforward as that, there's always some nuances. There's always a lot more to it, and that's what we've been talking about earlier in the program. And so when you think about TikTok and a 30-second video to talk about investing, maybe that's not the best source of information. But at least the good news when you think about Generation Z, which is adults 18 to 24, they are certainly engaged in that conversation, a little bit more financially aware of what some of the investment options are, if you will, out there. So that makes them more financially active, but unfortunately, maybe this is a reflection of the source of information, perhaps not more financially astute, particularly when markets get difficult, because that generation is just as susceptible as any other generation to the emotions of fear and greed. And we constantly see those emotions, no matter how old you are, play out when it comes to investing. It causes you to chase after things that performed well in the most recent past. It causes you to sell things prematurely when things aren't going particularly well. And certainly the statistics that have come out certainly would bear that out as well. So looking at some of the stats in terms of sales and transactions and active trading, if you will, 73% of Generation Z investors traded actively during the course of this year. 73%. Compare that with some of the older generations, the Gen Xers, which made my generation, 28% traded actively. Baby boomers, even slightly less, 25%. So some interesting numbers, some interesting statistics when you stop and think about, okay, how are people behaving? How are people reacting to what's going on in the headlines? Sort of got almost two opposite sides of the age group, right? The baby boomers clamoring for those annuities, which is always the case when you see markets go down, only to realize a year or two later, wait a minute, now I'm still stuck with this thing for another 3 or 4 years, and now interest rates are much higher than what I'm getting in terms of that fixed annuity. And oh, by the way, the insurance company is making a bunch of profit on that. That's a typical decision or a typical movement that we see whenever markets have any level of volatility. Annuity sales go way up. Folks, don't do that. That does not give you much of an opportunity to sort of recover and to stay consistent. Similarly, Gen Z, those numbers obviously are much more active trading, 73% of them having traded this year, in contrast to about 25% of baby boomers. So again, be careful with some of these reactions that are normal based upon market volatility, but at the end of the day, undermine your long-term results. We're gonna wrap it up and get on out of here. Enjoy the rest of the Sunday. This has been Joel Garris of Nelson Financial Planning on Dollars and Cents.